Managing Director and CEO of the bank, joining us to give us more details about the Q2 numbers. So, firstly, let's start off with your net interest margins here. Now, we saw a 25 basis points fall when it comes to the NIMs in this quarter, but going forward, your cost of deposits has been rising while the yield on advances has been declining. So, what's your outlook when it comes to the net interest margin considering these factors?
As regards the NIM is concerned, our NIM we have shown at around 2.80%. However, this is the global NIM. The domestic NIM is at 3.14%. And the reason for this coming down of the NIM is one of the factor is that 15% of our global book is the international book, where the NIMs are on a lower side. In fact, it is 1.17 at the global international level, our NIM. So what it has impacted is on the global level, it has impacted the overall NIM. So NIM has come down to 2.80%. However, I clarify again, our domestic NIM is at a healthy number of 3.14%. So definitely there has been some impact with the rising cost of deposit. The NIM has been impacted, and also the yield on advances are flat. That is one of the basic reasons. And as regards the RBI circular on penal interest, so now we have to book under the penal charges. So penal interest also has gone out of the interest income, and it has gone to the penal charges to the non-interest income. So that has also impacted the overall domestic net interest margins.
Right, sir. So if you could also tell us then what was the impact when it comes to the penal interest charges that have been charged to you in the second quarter?
So that is around 100 CR for this quarter. So penal interest was around 100 crores, and it has now gone to the non-interest income. So overall, in the domestic, if I can say that the NIM is at 3.14%, it's quite healthy. And at the global level, the guidance we are giving at that we'll maintain a NIM at around 2.9% for FY25.
Right, this is Shreyansi as well joining the conversation. I wanted to ask about your yield on advances because as per your earlier comments, those should settle around that 8.5% mark. So should we expect these then to remain at the same level also coming in from now on?
Yeah, it should remain at the same level. So yield on advances for us is 8.65 for this quarter. And if you see the repo rate, RBI has not changed after January 2023, and it remains at 6.5%. And as regards the MCLR for Bank of India, we have increased the MCLR from 8.4% to the latest MCLR of 1 year at 9%. So we have increased the MCLR by nearly 60 basis points during this period. So we see that the yield on advances should improve a bit better going forward in the next 2 quarters, and should be at around 8.65 to 8.70.
So if you look at your slippages that have also gone up sharply, specifically when it comes to the corporate segment. So are you seeing any rising stress when it comes to the corporate book? Because even during the last quarter, there is a Q1, you had made a prudent provisioning when it comes to the corporate book?
Yeah, as regards slippage is concerned, the slippage has been more than the last quarter. So there is one one lumpy account which has slipped during this quarter, and it is a one-off account only. And it should not happen in the next quarters. So further slippages we do not foresee in the corporate book. There was one single account, and because of which the provision has also increased. If you see our provision numbers, to that extent, the provision has also increased on a quarter-on-quarter basis.
All right, I had a follow-up question about that because this one particular account that you've mentioned, do you feel confident about this account's recovery then in the coming quarters? Any resolution plans that you're currently working on?
So we are very confident that some resolution process will come out either by way of a payout or some restructuring may happen in the account. So whatever the provision is required as per the IRAC guidelines, we have already provided. So if you see the slippage ratio and the cost of credit has gone up due to this one particular account. Had this account not been there, if you net off this particular account, the gross, our slippage would have been less by nearly 1,000 crores, and gross and net NPA would have been much better than the last quarter. And in fact, the slippage ratio and also the credit cost would have been much lesser than the June quarter. So overall, the improvement was there in the asset quality, barring one single account, which is an aberration for this quarter.
Also, sir, if you look at your advances, the growth is healthy on that front, but deposit growth has been lagging and also it's below your guidance. So what are the measures that you're taking to boost deposit growth? And do you think that that the bank's credit deposit ratio at current level is comfortable?
Yeah, so on the global numbers, if you see, our business has grown by nearly 12%. On the global advances, we have grown by around 14%, and the global deposit has grown at around 10%. However, if you see the domestic book of the bank, our domestic book has grown by 13%, domestic advances have grown by 15%, and domestic deposit has grown by nearly 12 to 13%. So that is the number at which we are growing at the domestic level. So overall, if you see our CD ratio, the CD ratio at the global level is at around 80, but at the domestic level, it is at around 77, which is a very healthy number. At the global level, it is high because at the international book level, we have to we raise less of deposit, but more of loans and advances from international high street banks to take care of our credit growth, which is happening at the international market, because of which the overall CD ratio is at 80. However, the domestic CD has a very healthy number of 77. As regards the gap which is there between the growth of the incremental growth of deposit and advances, see, our YOY growth has been 1,50,000 crores on a YOY basis as on September. Out of that, 78,000 crore has been the increase in the advances, and around 72,000 has been the increase in the deposit. So this gap of around 8,000 crore is not much of a gap. We have ample resources available from us other than deposits through which we are funding our credit growth. One being that we had raised infra bonds of nearly 5,000 crores. We had a tier two raise of also 2,500 crores. We are raising CD also, and we are also raising refinance also from the market, and we have excess SLR also with us, nearly 45,000 crores, against which also we borrow. So all these things put together, we are very comfortable for raising resources to meet the credit growth in the ensuing quarters.
All right, so I also wanted to talk about your profitability then, because that has also remained healthy. When you take a look at the second quarter coming in, you also reported ROA of 0.94% also, but I believe that this was also supported by higher non-interest income. So going ahead, how should we then be looking at non-interest income segment and also your ROAs then?
Yeah, so non-interest income has improved for us. As you see that we have crossed 2,500 crores in the non-interest income, and it has grown by nearly 40% plus on a YOY basis. So healthy improvement has been there, and it is at the backdrop of some recoveries in the return of accounts. In 7, 8 accounts, we got recovery. So there was no one single account or a lumpy account which was there. It was 7 or 8 accounts in the NPA book in which the recovery had happened during the quarter. That is one. And other part is with the treasury income, in which we have booked income in the treasury segment. And some improvement has also been in the third party products income and other few heads also. So we are very confident that this non-interest income will be sustainable in the coming quarters also in Q3 and Q4. And as regards the ROA is concerned, so we have shown a very healthy ROA this time of 0.94. And we are confident that we'll be touching a ROA of near to 1% in the ensuing quarter of December and March also.
So it is also worth noting that the SMA book has come down, but the specific SMA 1 and SMA 2 is still a little elevated. Given the guidance of GNP is below 4% and NNP is below 0.9%, how confident are you in terms of recoveries from here on?
You must have seen that our SMA book above 5 crores has come down from 9,600 crores to 7,600 crores. There is a reduction of 2,000 crore on a quarter-on-quarter basis, within which, as you rightly said, there has been some increase uptick in the SMA 1 and SMA 2 numbers. If you see the data more granularly, you will see that this SMA 0 number, which was high at the time of June quarter, these accounts have moved from SMA 0 to SMA 1 and 2 in the September quarter. So these are 5 or 6 public sector accounts in one particular state which have gone into SMA 1 and SMA 2 category. However, we are very confident that the slippage will not be there, and they are also backed by asset, and also the government guarantee is there. So we are very confident that the slippage will not happen in those accounts. It is only if you remove these accounts, which is nearly 4 to 5,000 crores, the overall SMA numbers is quite comfortable for the bank. In fact, the overall SMA number to standard advance is only 1.7% of the total book. So that we are very confident of. And as regards the gross and net NPA, you see that our gross NPA has now come down to 4.41%, and it has the reduction of nearly 160 basis point on a YOY basis. And if we see the net NPA, we have shown the net NPA at 0.94%. Again, here also there has been a reduction of nearly 60 basis point on a YOY basis. So we are very confident that the FY25, the gross and net NPA will be at the level which we have already given a guidance to the market.
Well, absolutely. But in this environment, then, given the slippage guidance of 1.2% earlier, do you think that the bank can still achieve that level then?
Yeah. So we are revising this guidance of this slippage because for the simple reason that one single account has slipped during this quarter and it was a lumpy account. So the slippage ratio, we are now estimating it to be at around 1.4% on a realistic basis.
All right, and that was the take coming in from the management of at Bank of India. Thank you so much for taking time out and joining